Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Welcome, Professor. Today is December 18th, 2024. We're here with renowned econ professor at the University of Virginia, Ed Burton. Welcome, Professor.
Good to see you, Hunter.
Professor, you predicted a 100% chance the Federal Reserve will lower the federal funds target rate today. They'll be announced the next hour or two. Do you stand by that prediction, and what's your prediction for 2025?
There's no question that today the Fed will lower the target funds rate from 4.5 to 3/4 to 4.25 to 4.5. And the reason they're going to do that is if you look in the Treasury market, you'll see that Treasury bills are in the 4.30 area. If they leave the federal funds target up at 4.5 to 3/4, nobody's going to buy T-bills. And that's the last thing the Federal Reserve wants, or the U.S. Treasury. So you will see a 25 basis rate cut. You can always predict the rate cuts just by looking at the T-bill market. Now you ask what will happen in January. That's the next time they meet. We don't know. It's hard to say. It depends on where the T-bill market goes. If T-bills start going back up, you might find the Fed raising the target funds rate. Let T-bills go back up to 4.60, and then the Fed will surprise the market. It won't surprise me because I'll predict it once again. Notice the press conference is going to come afterwards today. Powell will get up and give all the reasons that he's cutting rates. And what are the reasons? Well, inflation's getting stronger. Is that a reason to cut interest rates? But it is getting stronger. The latest two readings show a pop in the inflation rate and showed a pop in the producer inflation rate. So inflation's getting a little worse. The economy is super strong. Another reason to cut rates, I guess. Let's get the economy going even more strong. There just isn't any argument at all based on the usual macro models to cut rates. You cut rates when the economy is weak. You cut rates when inflation has been conquered. Neither one of those facts are true, but they're cutting rates anyway. So why are they cutting rates? Because rates have already come down. The T-bill market has already come down. They have no choice. The Fed is a follower. They are not a leader. And I don't know when people are ever going to wake up to the fact that if you want to know what the Fed's going to do, let's get to that second week in January, and then I'll tell you. And if the T-bill yields are below 4.25, guess what? They're going to cut. If T-bill yields are above 4.5, guess what? They will reverse course and raise. Just watch the T-bill market.
Professor, we had something happen yesterday. Has not happened in 45 years. Hasn't happened since 1978. We had 9 consecutive days of decline in the Dow, where the economy's strong, but there's some data points showing weakness. Is the economy getting better, getting weaker? What's your prediction for next year?
I think the economy is going to get a lot weaker, and part of it's going to be a little reshuffling of the agenda, going from the Biden agenda to the Trump agenda. The Biden agenda put more than $1 trillion into the climate change agenda, providing credits and grants and this and that and the other. The Trump folks are going to pull back on all that. The electric vehicle mandates, for example, the ones you see in California and even the national ones, those are going to be pulled back. So many of the things that were stimulating certain parts of the economy are going to pull back, and that's going to weaken those sectors. There's no question about it. Electric vehicle sales, I'm sure, will tumble once you don't have the credits out there. And I think even in batteries and infrastructure for electric vehicles, there'll be problems, and there'll be other problems in related areas. So that's going to take effect once Trump enters the White House, and he can do that. He's the president. He's the executive authority, so he can spend what he wants to spend. And if he chooses not to spend money that's been allocated to that, he can do that, at least for a while. And then there are other areas that had been weakened pretty dramatically by the Biden shift, because when you take resources from one part of the economy and put it in another, that weakens the part of the economy you take it. So there'll be a lot of problems here. And what areas have been weakened? Well, you can see it in infrastructure if you define pipelines, for example, as infrastructure, or then Biden immediately abandoned the Keystone Project on day one. So the result is we ship all that oil and gas by trucks, which is not nearly as safe as shipping it through pipelines, but the political wherewithal was not there to keep the pipelines going, and the same is true of pipelines all over the country. For some reason that escapes me at least, we prefer having these big trucks going up and down the highways, and those of you who drive on the highways, you see them when you're out there, as opposed to simply safely shipping that through pipelines that can be protected and taken care of. So there's going to be a lot of changes. When you move from Biden to Trump, now you're going to spend a lot of money in a different direction. And there are already signs the economy is weakening. There are a variety of things, almost everything you would point to, unemployment claims, et cetera. Unemployment claims have nudged up recently in the last couple of months. So you can't prove definitively the economy is coming off, but you never can. Anytime you're at a turning point in the economy, you never know it until it's turned. In fact, you often don't know it until 6 months after it's turned. I think it's turning right now. I think the economy is weakening in America, and I think there are real caution signs for the stock market as well, and even the bond market. Why in the bond market? I noticed T. Rowe Price yesterday was in the news saying there's a danger the 10-year yield's going to 6%. That's an interesting prediction. I said, we're a long way from 6%, and yet one of the largest money managers in the world has said there's a danger that might happen. And you're beginning to have increasing numbers of people who point to the large level of the national debt in the U.S. and the difficulty at these auctions. And that's exactly what T. Rowe Price pointed to. And others have been pointing in that direction. And that has implications for the stock market. You may see at the same time the bond market weaken. That's what happens when rates go up. And the stock market weaken as well. Now, we've seen the opposite happen for a number of years. We're at the biggest bull market in history in the stock market, and the biggest long bull market in the bond market ended 4 years ago. But it was the biggest long bull market in bonds when rates fell almost without ever having much of a blip from 1981 all the way to 2020. You had nothing but wind at your back if you were financing or anything else. That's been reversed. It might get worse. So I think there are real caution signs out there about the stock market. Let me say another thing about the stock market. The last couple of years, or at least the last 24 months, it's been driven by Bitcoin, which is up 500% from a year and a half ago, and artificial intelligence. And you can see it in NVIDIA. Well, NVIDIA is in a great spot. If you like artificial intelligence, you got to buy a lot of NVIDIA hardware, and they make hardware. So NVIDIA actually makes hardware and sells it and makes profit. But if you're in the software side of this and you're buying NVIDIA products like your Microsoft and Apple and everybody else, and you're trying to put artificial intelligence into your products, this is a cost item. And the cost is enormous. It's not only enormous in buying the NVIDIA stuff, but the software engineers. It's costly in terms of the energy requirements. The energy requirements for AI are far, far bigger than the energy requirements for other computer applications. So you've got a lot of cost built in. Now, when Microsoft goes out and spends a lot of money on AI or any other company, that's considered a capital item. That's a capital expense. So their bottom line doesn't even suffer. When they report their earnings, the fact that they've spent all of this money, and even if they've wasted every bit of it, it doesn't affect reported earnings. But it does affect their ability to generate cash because they have to spend money to do all this. So what you're probably going to see as the year develops is that companies' earnings, reporting earnings, look okay. They'll report, hey, our earnings are up 6% or whatever. But the actual cash that they show on the balance sheet is going to be hit hard by the capital expenditures. Some of the companies have already realized that and have begun pulling back on artificial intelligence research and development. Because the only way AI helps you if you're not in the hardware business is if you can use it to cut your costs, lay off employees, substitute AI for them. And there's no evidence anybody's doing that. You hear people talk about it. Everywhere I go, people say, oh, we're going to cut all these employees. We're going to do all this stuff with AI. But I don't know anybody that's actually doing it. I want to meet the first person that actually succeeds in doing that. You also see people say, we're going to get a better price for a product. Well, I just bought a new Surface Pro just 3 months ago. Surface Pro has Copilot built in, artificial intelligence built in. Paid the same price I paid 4 years ago for my last one, and this one's more powerful. So if Microsoft's making more money selling the more powerful product at essentially the same price, it's not clear artificial intelligence is really generating a lot of profits for them. So I think the AI boom and Bitcoin's problem is it's a product looking for a purpose. I don't use Bitcoin for anything. And when I ask my students who love Bitcoin, the students are big fans of Bitcoin. I say, what would you ever use Bitcoin for? And they say, well, it's a way to pay people. And I'll say, there are pretty good ways to pay people already. Why would you need Bitcoin to do it? And you just don't get anywhere. I've watched Warren Buffett's comments on this. He says the same thing I'm saying. When I find somebody who can actually use Bitcoin for a real purpose, I'm not comfortable as a safe an asset as the S&P. I'd rather own the S&P than Bitcoin any day. I think Bitcoin has the possibility to be a lot more volatile than the S&P, and certainly it's more volatile than the value of cash. So it's not a great store of value. I don't mean to throw so much cold water on a product that the incoming administration loves and the outgoing administration is trying to defend, and a number of high-flying folks in the money management industry have decided Bitcoin is here to stay. I doubt that. I think Bitcoin is a bubble waiting to burst, and I think artificial intelligence is a bubble waiting to burst. And I think this time this could be pretty bad when it does.
Professor, you've said repeatedly that increasing the money supply results with a delay in an increase in price levels. What's the best metric for gauging money supply? Is it M1, M2? What's the best metric?
Over time, that has changed. In the 70s, when Milton Friedman was roaming the academic halls, M1 was the one that he liked best. So what are these? M1 is basically coin and currency that is held by the non-bank public, your dollars and pennies and quarters, and your checking account, not your savings account, but that checking account that in those days paid zero interest. That's not true anymore, but it was true when Friedman was writing about it. And that's why he chose just checking accounts, because they didn't pay interest. Nowadays, M2 broadens that definition, and checking accounts pay interest now, not much, but they pay a little. But they broaden that definition to include savings accounts. And so now if you take the broader amount, what you think of all your savings accounts at the local bank, that basically is M2. Now there's M3, M4, M5, all the way out to M18. And what they do is they add increasingly things like CDs come into M3, and then eventually you get Treasury bills coming into higher levels of M. So they're looking at things that have kind of a stable value that people might use for liquidity. But M2 are the things that you can write checks on or just hand people. That's M2. So that includes savings accounts and checking accounts. And by the way, that number was 14.5 trillion in early 2020, 14.5 trillion. And 16 months later, it was 22 trillion. It went up 50% in a year and a half.
Which leads to the next question. Have we ever had inflation without an increase in the money supply? And have we ever had an increase in the money supply without a resulting increase in inflation?
That's a great question. And they have different answers, strangely enough. There's never been a recorded bout of inflation anywhere in history, even going back to Greek and Roman days, without a dramatic increase in the money supply. Never been a single one. So we don't have any examples of inflation taking place without a big increase in the money supply. But we do have two pretty contemporary examples of increases in the money supply that were substantive. The United States from 2009 to 2019, where the average increase in M2 was 7%, way higher than GDP or inflation or anything else. And then the long experience in Japan, starting in the mid-1980s, including the turn of the century and right on up to about 5 years ago. The money supply grew pretty rapidly in both of those episodes, but there was no inflation to speak of, 1.5% or less in the U.S. and zero in Japan. That's changed, by the way. Today, after that period ended, we have inflation, and so do the Japanese. For the first time in several decades, there's inflation in Japan. So what happened? Why all of a sudden money that was sitting dormant began to spill out into the world and affect prices? And the answer to that is, if you're in a zero interest world, if you have money in your checking account and you say, well, maybe I should go buy T-bills. Well, 5 years ago, T-bills were yielding 0.11%. To make that extra nickel or dime, I don't think I want to move my money into T-bills. After all, it's complicated. I got to call somebody, I got to do something. So when you have zero rates throughout anything that you could move your money safely into, why would you do it? And so a lot of that money, cash, just sat dormant from 2009 to 19 with these very low rates. And Japan, same thing. They had very low rates, even had negative rates at one point. Wow, you get paid this. I was actually charge you a little bit to have it, but if you bought anything else, it was even worse. Now, what happened? Well, what happened was rates went up. Now, there's all kind of explanations for why rates went up, but it doesn't matter. Point is that now all of a sudden, if you can buy a Treasury bill that yields 2% a year, you're not going to leave that money sitting in zero interest money. And as rates keep going up, and they got to 4 and 5 and so forth, Americans just said, hey, I don't want to hold M2 anymore. I'm going to move that money out, and we're going to start doing things. But M2 doesn't go away, by the way. The effort to get rid of M2 goes to somebody else. And that just creates inflation, and it creates an increased demand for near money assets. People start buying CDs from banks, and people start buying Treasury bills, and that creates a spur in the market for T-bills as well. So I think it was the zero interest rates. You need a certain minimum interest rate to trigger getting that money out of a dormant position. So if you can keep rates at zero, then you can kind of increase the money supply all you want, and you won't get inflation. But obviously, if you keep doing it long enough, what'll happen is what happened in the U.S. and what happened in Japan. You get inflation, you get rates going up, and now it feeds on itself. And both countries still have inflation.
Professor, thank you. The Federal Reserve announces their decision today in the next 2 hours. We're going to see if you're right. I think you are right.
Watch the gyrations when they try to explain, because they'll be asked, why are you lowering rates when inflation's going up? Why are you lowering rates when the economy looks strong? Watch how Powell answers those questions. There really isn't an answer to that, and he's certainly not going to give my answer.
It'd be fascinating to watch in January of 2025 if they're forced to raise rates, because if the treasuries rise in the next 30, 45 days, that'll be fascinating to watch. Professor, you're the best of the best. Thank you, Professor.
Thank you, Hunter. My pleasure to be here.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.